Hello, good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinnii Motiwala, and thank you so much for tuning in as always. In today's episode, we put focus on the AMFI data, also in terms of large cap and mid cap funds. What is the trend there, the valuations there? Now, looking at the AMFI data, we're going to talk about the drop that actually came into the large cap inflows vis-a-vis the inflows that were in the small and mid cap funds. Fund flows, when you look at it in terms of inflows, are at around 1,250 crore rupees, a drop of around 53% that you see. Now, meanwhile, mid and small cap relatively fair between that range that we've seen coming in. Flows are seeing a bit of a decline in the mid and small cap as well on a month-on-month basis for overall the AMFI data for the month of May. But are, the valuations for these large caps still attractive? Why are people still going towards large cap funds versus a mid cap funds? Is that trend going to be changing? What is our understanding on that? In terms of volatile times, what do we watch out for? To talk to us and discuss about all of this, we have Kalpen Parekh, MD and CEO at DSP Mutual Fund, joining in with us to talk to us about all of that. Kalpen, good afternoon, and thank you so much for joining in with us. While it's important, to talk about valuations in this current market, what are the trends that shape up? But can you also highlight in terms of what is the trend that you're watching out in terms of AMFI data? Month of May, large cap funds saw a bit of a decline that came in. Any specific reason for that, and what are we watching out for going forward?
Vinnii, thanks for having me, and maybe I'll disappoint you because I don't have an intelligent answer to give any insight to very noisy data, because monthly data points are generally very noisy. I personally, as an investor, don't care about what are the patterns of where money is going in large, mid, small, and that is what I even discourage our investors also to get swayed by this noisy data, because we all are long-term investors with a 10, 15, 20-year time horizon. What is popular today or not popular is really, not really relevant. The second point I want to highlight is that overall, after the Jan-Feb March volatility, overall investors have become a bit nervous about increasingly investing more in equity. So to that extent, there is some bit of slowdown in new allocations. But this nuance, there's a nuance on this large cap and small and mid cap fall. Now, mid and small cap as a category has been popular for the last 5, 6 years now. And in these 5, 6 years, a lot of SIPs have gone into small and mid cap funds. So every month, the old SIPs are triggering and hitting the small cap and the mid cap category. But in the last 5 years, large cap as a category has not seen so many SIP swings or so many SIP users. So whenever new lump sum money slows down, the small and mid cap category gets the cushion of the SIPs which are registered 1, 2, 3, 4, 5 years back. And that is why this number tends to give you a slightly misleading impression. So what is important to know is that there is some bit of slowdown in terms of delta sales, but still investors are putting in almost 20,000 crores worth of their savings into the industry every month. And I always ask this, one very important thumb rule for me when I want to make a very large investment is I like to invest in categories where flows are lesser, because it
Okay.
means the world is not chasing that. So today for us, in fact, we've communicated extensively. We've come up with ad campaigns in the last 2 months to highlight about the fact that large cap funds are a better choice or a better place to invest at this point in time.
Absolutely. You are saying that, you've highlighted that as well. But so the valuation in the market, you still find it attractive, is what you're talking for large cap funds, and everyone should still look at it. Is that what you would say?
No. Okay, so I'll give you another nuance here, that this template that large caps are good or mid caps are good or small caps are
Yeah.
good, again, is a very self-defeating question to try and answer or seek an answer to. Each investor has to build his own investment plan, and that is governed by his risk appetite and time horizon. As of today, as we speak, valuations are expensive across the board. Indian markets are seeing revenue and profit growth rate of just around 8 to 10% in revenue growth and profit growth rate in the range of 10 to 12%. And yet, valuations across large, mid, and small are 25 to 30 times in that band, or 20 times to 35 times, depending on segment and sectors. So, from an intrinsic value perspective, almost most stocks are ahead of time by maybe a year or so. But we never get perfect conditions. We'll never get a day where everything aligns, where valuations also align, past returns also align. So these are things we should not worry about as long as you have a long-term plan. choose a flexi cap fund which will have a mix of large, mid, and small. Or if let's say you're starting your investments with an SIP, choose good small cap funds. Even small cap funds are relevant. I gave this advice to my nephew who became a father, 2 months back. So he was saying that all you guys are talking that small caps are expensive or risky. So I was telling him that your daughter is born today. She has a 30-year runway. You're starting an SIP. You cannot go and buy direct stocks. You don't have the expertise. You are a doctor. You focus on that. Instead, you start an SIP in two good small cap funds and continue with that. And secondly, when you do an SIP, only one installment is getting deployed at today's valuation. The second installment will come next month. Third will come third month later. So it doesn't matter what valuations are. SIPs actually make valuations a little bit less relevant. So we should not really worry about it.
Okay, shouldn't worry about it. SIP is the best way to go, I think. No matter what, ups and downs will be there in the market. Kalpen, with large caps, especially offering stability, normally you want like, okay, I want less risk, I go for large cap. You said mid and small caps also. That is also something that is higher, bit of a volatility there. There is different kinds of fund. You spoke about flexi cap fund as well. Now, how should investors approach portfolio allocation between these categories, managing the risk between these categories? And you're saying valuation obviously won't be much of a concern if you're doing SIPs, right?
Exactly. So, see, this is like asking someone that asking a CEO of a pharma company that what should my viewers buy today? Which medicine should I buy today? And there are some 20,000 different drugs which are available. So it's very difficult to give you a single answer for this question. All I'm saying is each investor needs to have his personal financial plan and not necessarily rely on very generic advice that people like me would give you here. Um, and secondly, it is not true that large cap funds are stable and small caps are not stable or vice versa. Good funds are good and bad funds are bad. So, in a year like 2007 and 8 or 8 and 9, large cap funds fell by 50% and small cap funds fell by 60%, but both fell by 50 to 60%. So, can you say large caps are stable? The answer is no. So, it is misleading when we give these type of easy labels to these categories. Fundamentally, equity is volatile and in the short term, it is risky, whether it is large, mid, or small. Today, all segments of the market are expensive. In fact, in the September to February correction of the last 5 months, many large cap stocks fell by 40 to 50%. Auto stocks, energy stocks, power stocks, they've fallen by 40 to 50%. Now, can you say large caps are stable? No, it is very misleading to make these inferences. Fundamentally, equities are volatile. Time horizon will solve for volatility. SIP will solve for volatility. Having some bit of bonds and gold will reduce that volatility at the cost of marginally lower returns. So that is a better way to solve for higher valuation and higher volatility, not necessarily the choice of large, mid, small. Unfortunately, there are 25 product categories, and how do I tell you that this one is right today and the other one is not right for you? Now, if you do not understand these things, first go and find a good advisor for yourself. Or secondly, start with a simple flexi cap fund. Don't have to worry about large, mid, small. Start with a flexi cap or a multi cap fund and start your journey.
Okay. Kalpen, I just want to understand now. What are the most common mistakes that normally people make, right? So when I'm checking out or when I'm looking at a fund to invest or when I'm looking at the market, you look at P's, you look at valuations, you look at the performance of the fund. What is it that one I should have a checklist as of now in this current market scenario, whether it's up and down, when you see that fall coming in since Jan, everyone was worried of what you should be doing with the funds that you're holding or in terms of SIPs. What are the mistakes that one should avoid and what are the checklists that one should have right now at such a time?
So I'll give you a very honest and authentic answer. I'll tell you how bad an investor was I in the first 8, 9 years of my career. How was I investing? So I used to, those days, all these websites were not there to show last 1 year, 2 year, 3 year returns. We had Excel sheets and we used to go and check which fund has given the best return in the last 3 months, 6 months, or 1 year. And I would go and invest there. And after I invest there in the next 3 or 6 months, something else would do well. So then I would shift from X to Y. And by the time I'm in Y, maybe fund Z starts doing well. So then I will feel very bad that I've invested in Y, but Z is doing well, so let me churn. So, you constantly keep jumping and you do not get the benefit of any single fund. You end up paying tax, you end up buying high and selling low. Whereas the right principle of investing is buying low and selling high. So, the first thing I learned in 2008 or 9 was this is the wrong way to invest. You need to do the opposite of that. So, my approach today, if I have to invest, is I look for 3 or 4 fund managers who are very sound in their investment ideology, who have a certain belief system, they stand for something. They will say that, I will invest in these type of companies, or I will invest in these type of valuations, and they communicate very upfront. They will, put out their communication very clearly. They will put out their do's and don'ts very clearly. They are people who are not selling their products. They are the ones who are constantly guiding investors that what are the risks which are there and how should you think about it. So one is to identify a few fund managers like that, and then say that, okay, now that I've identified these 3 4 fund managers, let me allocate to all 4 of them 25% each, because I don't know in the next 1 year who will do better or worse. Let me give it to all 4. You're building a team after all. You're building a team of a good opening batsman, a good spinner, a fast bowler, and a wicket keeper. So you build diversification of styles and fund managers. And then ideally in equity, I have learned you need to, you really start making money after you cross 7 or 8 years of being invested. So once you've invested, don't worry, don't keep checking your returns time and again, and keep acting. Give time, patience, and faith. If you've done your homework right at the time of selection. The challenge is most investors don't know the formula of how to choose funds, and yet they try to do that. And which is why we keep guiding that, we'll be happy if you come to our website and choose a fund, but how do we ensure you're choosing the right fund? You may be choosing the wrong fund for you. It may be right for me, wrong for you. So find a good advisor. There's no better advice than that first, is what I would say.
Okay. Kalpen, how should one be looking to invest? Like, you have SIPs that are there, you have lump sum that is there. So what is the best way in terms of allocation that you could look out for to maximize your returns, minimize your downside risk? That is what everyone wants to do.
So, Vinnii, firstly, this is a function of your pattern of cash flow. So for a lot of us, our cash flows come monthly. We get steady inflows every month, and then we have our expenses, and then we have some net savings. So by default, hence, SIPs become a better way to invest for 90% of investors. And which is why in the last 5 6 years, when mutual funds have become so mainstream in every household, people have embraced the concept of SIP. So the first best way of investing is SIPs. The second best way of investing is, if let's say, in my case, in the month of April, I got my annual performance pay, which was a lumpy chunk. So while I get my monthly salary, which goes into SIPs, this was a lumpy chunk which I got in the month of April. In April, I decided that my asset allocation that I want to run right now is 60% in stocks and 40% in gold and bonds. So basically a hybrid fund. Now that was a lump sum money. I could not do an SIP because it was lump sum. So that lump sum I chose to invest in a hybrid fund, which has a mix of equities and bonds, because stocks are expensive. I don't want to, invest in. That's my ideology as an investor. Yours could be different. So I chose a hybrid fund where the equity component is flexi cap and the debt component is basically actively managed. So it's a combination of equity and debt, 60/40 ratio. Someone could choose 80/20. Someone could say, I'm a 10-year investor. I don't know time. I'll go and buy equity because I've got money right now. But primarily, I would say monthly flows go into SIPs. Lump sum flow in today's understanding of our risk return framework, I would prefer a hybrid or a multi-asset.
Okay. On that note, we're going to actually sip into a break, but don't go anywhere, viewers. We're going to continue this conversation with Kalpen after the break as well, so do stay tuned in for that. Welcome back to IMF Corner on CNBC TV 18. We still have with us Kalpen Parekh, MD and CEO at DSP Mutual Funds. And today we're discussing a lot in terms of the investment strategy, large cap funds, valuations, what you should be looking at and how you should be actually following through it. Now, Kalpen, you did highlight a lot in terms of how one should be looking at investing in their portfolio. But for a first-time mutual fund investor or those looking maybe to rebalance, is it a good time to actually start increasing exposure right now to a large cap fund, or should they wait out for some market correction, or how should they be looking at the current scenario?
Vinnii, I've been waiting for 7 months for a correction. I got a correction of 18-20%. I could move 2% of my debt component to equity. I wanted to do 20, hoping that more correction will come, but it didn't come. And in a way, I'm disappointed that my new money has not got deployed. I'm slightly happy that the old money has gone up by 15-20% in the last 2-3 months. So unfortunately, getting this timing is almost impossible. So my framework again is, if you are a new investor and you're coming with a 10-year horizon, start with an SIP. Valuations just don't matter when you're starting with an SIP, and I'll tell you mathematically why. In a 10-year SIP, you will have 120 installments monthly. Today, you're investing only your first installment. So divide by 120 is getting deployed at today's valuation. Imagine someone had started an SIP in September last year when markets were high, was able to take advantage of October, November, December, Jan, and Feb correction in the SIP. So I think SIP solves for a lot of these things. It solves for your cash flows. It solves for doing for you what is meant to be done, which is when markets fall, you get more units. So I would say start with SIP first. And the second thing, if you have lump sum today, my bias would be to say that because valuations are rich right now, prefer conservative hybrid funds or multi-asset funds.
Okay.
So in two lines, SIP in flexi-cap funds slash multi-cap funds, and lump sum in hybrid funds.
Absolute. Okay, interesting word coming there. Kalpen, would you want to break the myth of saying, we started the conversation saying that large caps are safer. I mentioned that a couple of times as well. But what are the key risks that investors should, not overlook at such a time? Because you just think, okay, if I've invested in large cap, I'm safe and sound. I don't have to worry about anything. But there are some risks that one should watch out for there as well. So could you highlight that, maybe in terms of
Sure.
valuations or whatever the other
So
risks could
very,
be?
very valid and good question, Vinnii, because most people, carry wrong lessons that large caps are safe. Gold is safe. Today, the lesson everyone is teaching is gold is safe because it's gone up by 40% in last 1 year. But every asset class has, very high standard deviation. Whether it's gold, large cap funds, mid cap funds, small cap funds, they have high standard deviation, which means your real returns can be widely negative compared to your long-term average returns. What matters in investing? Where does the risk come from? Risk comes from two things. Risk comes from buying bad businesses or bad companies, or companies where governance is bad. The promoters or the entrepreneurs don't have integrity. They don't want to share the profits and cash flows with their shareholders. So avoiding bad businesses is one way of risk management. When you invest through mutual funds, you're solving for that significantly because mutual funds do have their own risk management frameworks to weed out these type of bad businesses and give you a combination of generally good businesses. The second risk, the second way in which you lose money is if you overpay. So in the year 2000, if you had bought some of the best technology companies of India, 2000 to 2010, they went up by 40% in terms of the profit growth rate per annum. The fastest ever profit growth that any company or industry would have bought. But the stock price return for 10 years was zero because in the year 2000, all these stocks had been bid up to 80, 90, 100 times valuations. So bad businesses and very high unreasonable valuations are the two risks that investors should be mindful of. Valuation risk to some extent can also be managed through time horizon and buying a good quality business because over time that business will keep giving you a lot of profits, dividends, and growth. But compromising on quality is the last thing you should do, especially in this type of bullish market. Every day there are new stories about new themes, new ideas. History will show you that every time you've invested in hot themes where last 1 year return is very good, most often investors end up with losing 30-40% of their capital.
Right. Kalpen, I just want to highlight a bit more. You're saying those hot themes give you the best returns, but you did start by saying, right, you would look at maybe something where not everyone is running to. So what should you be looking at and what is that not everyone is running to? Because everyone wants to, whether it was a defense theme, everyone jumped to that theme. Whether last year you had so many of those sector themes that were doing the trends, are doing the rounds. So what is it and how do you pick up on such themes then? How do you find it?
Vinnii, again, if you're talking to a lay investor who doesn't even, first of all, know how to invest in a mutual fund, to try and educate on which theme to look is something we should not even attempt because we are giving something which he is not capable of in terms of, achieving that outcome. But having said that, since you asked me this question, if you have to do thematic investing, ideally buy a theme which is in low cycle, where the last 2, 3, 5 year returns are either negative or it has underperformed most of the other parts of the market. Number two, the underlying companies and the businesses have to be sound. They have to be solid companies. And third, at some point in time, you're expecting some trigger where the theme starts doing well. So what was similar theme? You said something very nice that last 1 year, everyone was chasing thematic funds. So many new thematic funds were launched. But there was only one theme which was not hot. It was actually a cool theme. We used to call it cool theme in DSP because its returns were very cold. Its returns for the last 5 years had underperformed Nifty also. And that was the theme of BFSI. Banks and lending companies and insurance companies had massively underperformed in the last 5 years. And in the last 3, 4 months, they have caught up. They have started, delivering returns. So that is one way to think of thematic investing. That's one of the way.
Okay.
And especially if a theme is out of fashion, most likely the valuation will be reasonable. Having said that, today even the BFSI theme has run up in the last 3, 4 months. all asset classes have run up. Ironically, in the last 4 months, gold has run up, silver has started running, bonds have given good returns because rates have fallen, stocks have run up, global stocks have run up. So I think this is going to be a time for the next few years where investors have to moderate their return expectations, be less greedy, be more disciplined, and increase their time horizons.
Okay. Since we are talking about these trends and themes, I just want to understand right now, everyone is looking at silver related funds, silver related ETFs. That's the trend. So should one actually stay away, or is that the trend now that is picking up, and maybe you could make a quick buck in a
So
1 year time?
silver, unlike gold, silver has not participated in this move, barring the last 2 3 weeks. We also have launched a silver fund, and generally, what we try to do at DSP, we try to launch funds which are out of fashion or themes which are out of fashion because it means your valuation risk is out of it right now. So last year um, um, we did BFSI as a theme, or last year we launched a very interesting index fund called Nifty 10, the largest 10 stocks of India. So these were 10 stocks where in the last 5 years, they had significantly underperformed the rest of the market. At this point in time, around a month back, we launched silver because silver to gold ratio is at an all-time low. Silver to Nifty ratio also is at an all-time low. And, some bit of demand supply equation is turning favorable for silver. So in that context, relatively silver could be a better precious metals for those who want to add precious metals to their portfolio. But let me highlight what is not correct is that precious metals are safe havens because these are the headlines that I many times read. Even gold and silver for 10 years globally have given zero returns, or in a year or two, they can go down by 20-30% also. They are volatile asset classes. And there is no asset class which can give you 3-4% higher return than bonds if it does not have volatility. So investors need to learn that one lesson. If you want higher returns, these periods of volatility you cannot avoid. Whether you listen to me or to you, this is the reality of the market.
Okay, Kalpen, that is the reality of the market. That is what they should note down as well. But thank you so much, for today joining in with us on the show. Not only talking about large and mid-cap funds, how they should be placing their allocation, talking to us about funds across the board as well. So thank you so much, Kalpen, for giving us your time this afternoon. It's a pleasure having you on the show. And thank you so much, viewers, as always, for tuning in to Mutual Fund Corner on CNBC TV 18. Don't go anywhere. More market action on the closing bell.